A commodity ETF, exchange-traded fund, is a type of investment fund and exchange-traded product with the goal of tracking the performance of a specific commodity or a basket of commodities. Commodities are raw materials or primary agricultural products that can be bought and sold, such as gold, oil, wheat, or copper. Commodity ETFs provide investors with a convenient way to gain exposure to the price movements of these commodities without actually owning the physical assets. Here are some of the key pros and cons of investing in commodity ETFs. Pros. Diversification. Commodity ETFs often track a basket of different commodities, providing investors with diversification within the asset class. This can help spread risk across various commodities and reduce the impact of a poor-performing individual commodity. Liquidity. ETFs are traded on stock exchanges like regular stocks, which means they are generally more liquid than investing in physical commodities. This allows investors to buy and sell shares throughout the trading day at market prices. Transparency. Commodity ETFs provide transparency regarding the underlying assets and their performance. Investors can easily access information about the composition and net asset value of the ETF. Accessibility. You can invest in commodity ETFs through a regular brokerage account, making them accessible to individual investors. Cost efficiency. Commodity ETFs often have lower expense ratios compared to actively managed commodity mutual funds, making them cost-effective for investors. Cons. Tracking error. While commodity ETFs aim to track the price of the underlying commodities, there can be tracking errors due to factors like management fees, futures contract rolling costs, and market volatility. This can result in the ETF not perfectly mirroring the commodity's price movements. Futures-based. Many commodity ETFs use futures contracts to gain exposure to commodities. Rolling futures contracts can lead to additional costs and complexities, which may affect returns. Tax considerations. Depending on your jurisdiction, the tax treatment of gains from commodity ETFs may be less favorable compared to other investments, like stocks or bonds. Volatility. Commodities can be highly volatile, and their prices can fluctuate significantly in response to supply and demand factors, geopolitical events, and economic conditions. This volatility can lead to substantial losses. To access commodity ETFs, you can follow these steps. Open a brokerage account. If you don't already have one, you'll need to open a brokerage account with a reputable financial institution. Research and select. Research various commodity ETFs to identify the one that best suits your investment goals and risk tolerance. Look at factors like the commodities it tracks, expense ratio, and historical performance. Place an order. Once you've chosen a commodity ETF, place an order through your brokerage account just like you would for a regular stock. Specify the number of shares you want to buy or sell. Monitor and manage. Keep an eye on your commodity ETF investment, as commodity prices and market conditions can change rapidly. You can buy or sell shares of the ETF as needed through your brokerage account. Before investing in commodity ETFs or any investment product, it's important to do thorough research, understand the associated risks, and consider your investment objectives and time horizon. Additionally, consult with a financial advisor if you're unsure about how commodity ETFs fit into your overall investment strategy.